providing me the opportunity to deliver this presentation. Today's my presentation title is Comparing Portfolio Performance on the Different Strategies. Here's the contents. The first part is the introduction, and the second part is strategy specification. The third part is solving algorithm. The fourth part is evaluating performance, and the last part is numerical experiments. First of all, let's give me some introduction. In financial market, portfolio construction is the capital allocation process for given collection of assets. Since the stock market is nonlinear, evolutionary, dynamic, and complex, portfolio managers usually utilize some methods to help allocate. Rebalancing is the simplest and the clearest technique that adds diversification return to fixed-weighted multi-asset class portfolios, and rolling window approach is widely employed for rebalancing. The frequency of reallocation may be daily, weekly, monthly, etc., determined by the circumstances of economic markets. And for each rebalance, we choose different strategies, specification, and solving algorithm to build portfolios and compare their performance. Here we use unique solution portfolio that includes equally weighted, equal risk contribution portfolio, risk parity portfolio, and the constrained risk budget portfolio. The second kind of class is called optimization strategy portfolio, including mean variance strategy, equal risk contribution strategy, risk parity strategy, and maximum diversified strategy. And we use numerical methods and evolutionary algorithms to solve such a stochastic problem. Let me give some mathematical notation. We use some notations to represent the weight vector in a period, the mean return vector at some day, and the covariance measures at day, and also volatility vector. Since the rebalancing is performed on the fixed period basis, if we assume one period has k days, then the following relation holds. If we define the feasible domain by the D, and the inequality means the boundary. Equally weighted portfolio is assigns weights to each portfolio without optimization procedure, which means this approach is model-free and does not depend on the data. Risk parity portfolio assumes that correlations between assets can be ignored. That is, single volatility budget equals total volatility budget divided by the square root of number of assets. And then we can calculate weights for each asset by the formula. The equal risk contribution portfolio is each asset has an equal contribution to the portfolio risk. We can also have the formula to calculate. And the risk budget portfolio, where CI is the relative risk budget of asset I. SCI is the necessary condition for the solution of RB risk is unique. The constraint risk budget portfolio incorporates the inequality constraints into optimization. So we have this constraint problem. This notation represents the constraints are satisfied or not. Here we have some strategies that may generate multiple solutions, um, may depending on the initial value. Uh, Here, the mean variance strategy introduces a risk aversion parameter. The larger eta increasing, the more risk sensitive the investor is. And equal risk contribution strategy and risk party strategy. Equal risk contribution strategy suggests that an investor would like to assign equal risk into each asset without giving total risk budget, while risk party strategy indicates that the variance of each asset should be closer to the sigma, that is total volatility divided by the number of assets. And the maximum diversified strategy. It targets at certain portfolios with minimal correlated underlying and capturing a greater risk premium by achieving long-term returns at lower levels of volatility. In terms of solving algorithm, the first kind of methods is numerical methods. We use sequential least squares programming, trust region method, cyclical co-descent algorithm, and mixed item CCD algorithm to solve our problem. And the second kind of algorithm is the evolutionary algorithm. It includes simulated and genetic algorithm, particle swarm optimizer, differential evolution, and the Beetle anti-search. Here we'll introduce differential evolution in detail. If we denote the objective function as f, the mutation factor as m, crossover probability as cp, the population size is n, and the jth generation has population. Mutation is selecting 3 individuals randomly from the current population, satisfying each individual is different from previous one, and also different from WH to form the donor vector. Crossover is based on the components of the target vector and the components of the donor vector to develop a trail vector. And R is a random number, follows the uniform distribution, and I is a random integer. Then we update the next generation by the formula. Next procedure is evaluating performance. Here we choose Sharpe ratio, Sortino ratio, drawdown common ratio, and omega ratio. In omega ratio, xi is a random return of asset I, and its cumulative distribution function is fi. Here in our case, the omega ratio for a portfolio under discrete probability distribution is defined as this equation, where pi is a probability vector for each sample return, and tau is a threshold partitioning the returns to gain and loss. Here are our numerical experiments. We choose a dataset from the trading market that contains daily price values involving 19 underlying assets in 3 categories as listed in the following table, and it includes 2,190 trading days from 20 from 2040 to 2023. We explore equally weighted portfolio, risk budget portfolio, equal risk contribution portfolio, and constrained risk budget portfolio that generates equal weight assignments for given month portfolio volatility. And the following figure depicts the accumulated returns using different stochastic methods on the different strategies. It seems that the combination of MVS and DE produces the most satisfactory results in the sense of accumulated returns. Um, this table gives us the overall results for both unique solution portfolio and optimization strategy portfolios. It is noticeable that the unique solution portfolios have the largest leverage effect except for equally weighted portfolio. In general, the mean variance strategy promotes reasonable and decent results, which outperform others on the risk-adjusted basis, and spends relatively little capital reflecting by uh, MSW. Furthermore, it seems that differential evolution generates the best portfolio. In case the Sharpe ratio, and omega ratio are used to evaluate the out-of-sample performance. Thank you for your listening.